Hey everyone, it's Prashant here. Welcome to my YouTube channel and thank you for joining me in today's video. Let's dive in. Guys, when I graduated college and started my first job, that is when I started saving for my retirement in a 401k. At the time, I was unsure about how to save up for retirement and wasn't really sure how a 401k really worked. When I started digging into the statements that I used to get for my 401k provider through my employer, I used to see many different terms such as my contributions, my employer's contributions, vested balances, investment choices, and what I was invested in. At the time, without anybody to guide me, I was really unsure what all of this meant. And at the age of 23 or 24 years old, I was really scared to make any changes to what was going on anyway. I'm sharing this story with you because I think this is a common thing that happens to a lot of people. In fact, I have discussed this with my wife and my closest friends and realized that a lot of people don't exactly understand everything that goes into their retirement plans. Because a 401k is complex and difficult to understand, a lot of people either don't completely understand but still contribute towards the plan, or even worse, they never contribute to the plan and miss out on a huge wealth building opportunity. Once I finally decided to start my personal finance journey, it took me months to understand my 401k plan. In this time, I read countless articles, read many books, and watched hundreds of YouTube videos on the topic. After doing all of my research, I carefully formulated my investment plan for my funds within my 401k account. After that, it took me many more months to actually implement this plan because I was so nervous. Even when I started implementing my plan, I only did that for the funds that I was going to contribute in the future starting that date, and let the funds that were already invested within my 401k be where they were. Many more months after that, after carefully comparing the returns that I was getting under my new plan versus the old plan, I finally felt comfortable enough and confident enough to move all of my funds from my existing plan to the new plan. And guys, let me tell you, I could not be any happier about this. You see, when you sign up for a 401k plan, your employer typically puts you in a target date retirement mutual fund. What this means is that all of your contributions as well as any employer match will go into this fund. There are hundreds of these funds offered by many different companies. For example, my money was invested in a target date fund offered by Rowe Price called the Rowe Price 2055. This means that they calculated that I would retire from the workforce around the year 2055 based on my age and put my funds along with a lot of other people's money in this one fund. This is actually a very popular type of fund in America. In fact, according to a Vanguard report published in 2019, 52% of plan participants under Vanguard had their money in a single target date fund. This means that more than half of all people who are invested within a retirement account with Vanguard are using these type of funds. Now you might be asking, Prashant, what is a target date fund? Well, I'm going to tell you right after you hit the like button and the subscribe button and share this video with someone who you think will find this content useful. This helps me out a lot with the YouTube algorithm and motivates me to keep making these videos. Now let's get back to it. A target date fund takes all the money from plan participants who are expected to retire in or around the year that the target date is set for example, 2055, and invests it according to what the fund managers think is best for those people. For example, a fund that has a target date 40 years into the future might be invested heavily into stocks and not so much into bonds. On the flip side, a fund that has a target date just 10 years into the future would probably have much more exposure to bonds. These fund managers analyze individual stocks and decide whether it is a good idea to include that stock into the plan portfolio. For doing the work of analyzing these stocks, choosing the investments, and then buying and selling these investments on a regular basis, these fund managers charge a fee to the plan participants. This fee is calculated as a percentage of the total amount of funds that each individual plan participant has in this fund. This is also known as expense ratio. For example, the Rowe Price 2055 target date fund has an expense ratio of 0.71%. This means for every $10,000 that you have invested with this fund, they will charge you $71 per year. You can actually go ahead and do some reading about this. Just Google any fund that you're interested in and you can find out exactly what their expense ratio is. And if you're invested in one of these funds, you can actually go ahead and request a prospectus about this fund. The prospectus will probably be several hundred pages long and give you a lot of detailed information about that particular fund. I did the research and figured out exactly which stocks and bonds my target date fund was invested in. And I decided that I could do those investments myself at a lower cost with more control using a simple 3-fund portfolio. A simple 3-fund portfolio is adequate for most investors as long as they're investing for the long term in a disciplined manner. As the name suggests, a 3-fund portfolio has 3 different types of funds, each providing a certain return and risk characteristic to the portfolio. Let's dive in. Fund type number 1, US stocks. The first type of fund in a 3-fund portfolio is US stocks. Now, this does not mean that you have to go and buy individual stocks that are based in the US. Far from it. This simply means that you can purchase an index fund which allows you to own the stocks of many different American-based companies all at once. There are a couple different options of how to do this. Option number 1, own everything. The first option is to own everything. This option allows you to own stocks in every company that is listed on the New York Stock Exchange. If a company gets delisted because of a bankruptcy or going private, the fund drops that company. If a new company gets listed on the stock exchange, this index fund buys shares into that company. This is a really easy and cheap way of owning stocks in the entire stock market. There are many different examples of index funds which allow you to do this. Some examples are up on the screen now. Option 2, own select stocks. This option allows you to be a little more selective when it comes to picking your stocks. You can still use index funds to be selective when picking your stocks. You can either choose to invest in sector funds, such as those that track energy stocks or tech stocks, or you can choose to invest in the top 500 companies or the top 3,000 companies by market capitalization. Examples of such index funds are up on the screen here. For example, let's talk about the Vanguard's S&P 500 index fund. This fund allows you to invest in the top 500 or so companies by market capitalization listed on the New York Stock Exchange. If a company that is currently listed in the S&P 500 index starts doing poorly in the future, it just gets booted out. On the contrary, if a company starts doing really well, it can then be included in the S&P 500. The most high-profile recent example of this is Tesla, which was included in the S&P 500 in December of 2020. This raises the bar for entry in your portfolio and gives you a simple, clean, non-emotional, mathematical way of choosing what companies you end up investing in. Personally, I'm a big fan of Vanguard's S&P 500 index funds and use it to do a majority of my investment. Fund type number 2, international stocks. As the name suggests, this fund family consists of international stocks. Now you might ask, why do you even have to bother with owning stocks in international companies? Well, the reason is diversification. You see, every once in a while, the US economy might have a bad year while other countries do not. And in these years, if you were invested in stocks in international firms, your stock portfolio might end up doing better than if you were not. Again, there are a couple of options when it comes to owning international stocks. Option number 1, own around the world. This option allows you to own stocks in companies based in countries all around the world. This includes developed countries such as the US, UK, and Canada, as well as developing countries such as India, China, and Brazil. A few examples of index funds of this type are up on the screen here. Option 2, own in specific regions. This option allows you to own stocks in companies based in specific regions around the world. For example, you could own stock in companies based in the developed world, developing world, or specific regions such as Europe or Asia. One popular index is EAFE, or Europe, Australasia, and Far East. Examples of funds in this category are up on the screen now. The choice of owning funds all around the world or developed countries or developing countries is based on your risk tolerance. Stocks based in developing countries tend to be more volatile due to market fluctuations and also currency exchange rate fluctuations. Personally, I like to invest my money in international stocks in the developed world. I find it too risky to buy stocks in developing countries. Finally, fund number 3, bonds. The third type of funds that goes in a 3-fund portfolio is bonds. Now, this fund family will not provide your portfolio with substantial gains. So why do we even bother? Well, again, diversification. This fund family will protect your portfolio from going down a lot during times of economic distress. Just like individual credit scores, companies as well as government entities such as municipalities, state and federal governments receive credit ratings. There are 3 main credit rating agencies, Standard & Poor's, Fitch, and Moody's. The ratings provided by all 3 agencies are pretty similar. Credit ratings go from D, which is the worst, to AAA, which is the best. Credit ratings BBB, A, AA, and AAA are considered investment-grade bonds and are considered lower risk. Ratings from BB all the way through D are considered junk bonds and are considered to be very risky investments. Just like with stocks, you can use index funds to buy bonds. And there are again a couple of options. Option 1, corporate bonds. The first option is to buy bonds offered by a company. Companies will often issue bonds to borrow money from investors instead of a bank. They do this because banks will typically have more stringent requirements for the repayment of those loans rather than the bond market. Corporate bonds are considered higher risk than government bonds, and so they earn high rates of interest. Corporate bonds often have call provisions which allows the company to prepay the bond if they think that they can reissue the bond at a lower price. This can leave the investor with a lower rate of return than they initially expected, with no choice in the matter. Examples of index funds investing in corporate bonds are up on the screen now. Option 2, government bonds. The second option to invest in the bond market is buying government bonds. Government bonds are debt securities issued by governments in order to fund infrastructure spending, infrastructure maintenance, or other government functions. Government bonds are considered less risky than corporate bonds, and so they earn a lower interest rate. US government bonds have the full faith and backing of the United States government. In fact, the US government has a credit rating of AAA according to Moody's, and it has never defaulted in paying back its debt. Examples of index funds investing in US government bonds are up on the screen now. Personally, I like using US government bonds to invest in the bond market. Since I'm using bonds to protect my portfolio in the case something goes wrong in the economy, I'm okay with the lower rate of return for the lower risk. So you see guys, using the 3-fund portfolio, I was able to set up an investment strategy within my 401k account that I feel confident will give me equal or excess returns when compared to the target date fund that I was previously invested in. Since I use index funds, my investments are well diversified and my risk of exposure to any single individual company is really low. Now, when I was invested in my target date fund, most of my money was still invested with index funds within the target date fund, but at the same time, there were some more individual investments that I did not agree with. In addition to that, using the 3-fund portfolio gives me more direct control over my investments. On top of this, target date fund managers have a habit of buying and selling stocks very, very frequently because they're trying to do what's best for the fund in their opinion. However, I think this is the wrong approach. I'm of the old buy and hold train of thought. It is my thought that you should choose your investments carefully, and once you have bought them, you should hold them for a very, very long time. In fact, till you need the money in retirement. This is something that I've learned from the great Warren Buffett, who invests in companies he believes have a great long-term outlook and then holds those investments for a very long time. The third thing that I really enjoy about my 3-fund portfolio is the low fees that I get charged. For example, VOO, Vanguard's S&P 500 index ETF that I personally invest in, has an expense ratio of just 0.03%. This means that for every $10,000 invested in this fund, I get charged just $3 per year. Compare this to the $71 that I was being charged when my money was invested in the Rowe Price fund. This is a savings of 88%. This means that I can use all of these savings invested back into the stock market, buying the same stocks that I already like, and thus increasing my gains even more. That's all I have for you guys in today's video. I really hope you enjoyed this video and learned something about target date funds, index funds, and the 3-fund portfolio. If you did, please go ahead and hit that like button and that subscribe button and hit the bell icon to be notified instantly when I post a new video. Please go ahead and leave any questions that you might have in the comment section below and I'll be sure to respond to it. This helps me out a lot with the YouTube algorithm and motivates me to keep making these videos. I will be posting here at least one video every week with great new financial content, and I hope to see you back here. Also, go ahead and follow me on Twitter and Instagram. I will leave those handles down in the description below. And don't forget to get your free stocks on Webull when you use the link in the description below and deposit $100 in the platform. Thank you so much for watching and see you next time.